There's a number that has quietly destroyed more financial dreams in the last 3 years than any stock market crash, any banking crisis, or any recession ever could. It is not the inflation rate. It is not the unemployment number. It is not even the federal funds rate, which is the number the Fed talks about constantly, the number that gets the headlines, the number that politicians point to when they want to look like they are doing something. The number I am talking about is the mortgage spread. And I promise you, by the end of this video, you will never look at a Fed press conference the same way again. Here is what is happening right now. The Federal Reserve has been cutting interest rates. You have probably heard that. The narrative in the financial media is simple. The Fed cuts, borrowing gets cheaper, mortgage rates fall, the housing market opens back up, and the people who have been sitting on the sidelines waiting to buy finally get their shot. That is the story they are selling. And millions of Americans are sitting in rental apartments, refreshing Zillow every morning, waiting for that story to come true. It is not coming true. And the reason why is something the Fed will never say out loud at a press conference, something you will not hear in a 2-minute segment on cable news, and something that the real estate industry has a very strong financial incentive to keep you confused about. What is happening to mortgage rates right now is not an accident. It is not a glitch. It is the direct result of a structural shift in how the American housing market is funded. And once you understand it, you will realize that waiting for rates to fall back to 4% is not a strategy. It is a trap. Let's start with the basics, because I want to make sure everyone watching this is on the same page before we go deeper. When you go to a bank and take out a 30-year fixed mortgage, that bank does not just sit on your loan for 30 years. What it does is bundle your mortgage together with thousands of other mortgages, wrap them into a financial product called a mortgage-backed security, an MBS, and sell that product to investors. Those investors might be pension funds, insurance companies, foreign governments, or for about a decade, the single largest buyer in the room, the Federal Reserve itself. During the pandemic, the Fed went on one of the most aggressive bond buying sprees in financial history. It was called quantitative easing. And at its peak, the Fed was buying around $40 billion worth of mortgage-backed securities every single month. Every month. What that did was create an enormous guaranteed demand for mortgages. Banks knew they could always sell their loans. Investors knew the Fed was backstopping the market. And because there was so much money flooding into MBS, the return those investors demanded, the yield, stayed low. Low yield on MBS means low mortgage rates for you. That is how we got to 3%. That is how we got to 2.8%. The Fed was essentially subsidizing your mortgage without most people ever knowing it. Then everything changed. In 2022, the Fed pivoted. Inflation was running hot. They needed to tighten financial conditions, and they made the decision to not only stop buying mortgage-backed securities, but to actually allow the ones they held to roll off their balance sheet without replacement. This is called quantitative tightening, QT, and it is the most important thing happening in the housing market right now that nobody is talking about plainly. When the Fed stopped being the buyer of last resort for MBS, the market had to find real buyers, private investors, hedge funds, foreign capital. And those buyers, unlike the Fed, actually care about risk and return. They are not buying MBS out of a policy mandate. They are buying it because they need to make money. And right now, with the economic uncertainty we are sitting in, they are demanding a higher return to take on that risk. Higher return on MBS means higher mortgage rates for you. Now here is where it gets personal. And I want you to stay with me for a second because this is the part that connects everything. You have probably been watching the 10-year Treasury yield. Most people who follow this stuff know that mortgage rates track roughly alongside the 10-year. When the 10-year goes up, mortgage rates go up. When the 10-year goes down, mortgage rates are supposed to go down. And here is what has been happening over the last 2 years. The 10-year has moved. It has had its ups and downs. But mortgage rates have stayed stubbornly, almost offensively, high. 7%, 7.5%. Refusing to budge in any meaningful way even when treasuries soften. And the reason is the spread. The mortgage spread is the gap between the 10-year treasury yield and the 30-year fixed mortgage rate. Historically, that spread runs somewhere around 1.5 to 1.7 percentage points. The mortgage rate is little higher than the treasury because mortgages carry more risk, people refinance, people default, the timeline is uncertain. But that spread has a normal range. And right now, that spread is not normal. It has blown out to somewhere between 2.5 and 3 percentage points depending on the day. That extra point or so does not sound dramatic until you do the math on a $400,000 home over 30 years. We are talking about tens of thousands of dollars of additional interest that you are paying, not because treasury yields are high, but because the market is pricing in a level of risk and uncertainty that it has not priced in since the 2008 financial crisis. So why is the spread blowing out? Why are private investors demanding so much more to buy mortgage-backed securities right now? Part of the answer is what we covered in our weekend protocol video. And if you have not watched that yet, I will put it in the description because what I am about to say will make a lot more sense with that context. The emergency liquidity that has been moving through the banking system over the last couple of years is not flowing into the mortgage market. It is not reaching you. It is being absorbed by the banking sector itself, sitting in facilities like the reverse repo window, being used to shore up balance sheets at institutions that are quietly under stress. Banks are not flush with cash that they are eager to lend out on 30-year mortgages. They are using liquidity to survive. And when banks are in survival mode, they tighten lending standards, they demand higher returns, and the cost gets passed directly to you in the form of a higher rate. Now, drop your comment below. Where are you watching from? I want to know which markets are feeling this the hardest because what I am seeing in the data suggests this is not hitting every city equally, and I want to address that before the end of this video. The second reason the spread is elevated goes back to something that sounds technical, but is actually very simple when you break it down. When interest rate uncertainty is high, when nobody really knows whether the Fed is going to cut once, twice, or not at all in the next 12 months, investors who hold mortgage-backed securities face something called prepayment risk. If rates drop, homeowners refinance. When homeowners refinance, the MBS investor gets their principal back earlier than expected and then has to reinvest it at lower rates. That is bad for the investor. So when uncertainty is high, they demand a higher yield up front to compensate for that risk. And right now, rate uncertainty is about as high as it has been in a generation. The Fed is sending mixed signals. The dot plot is getting revised every quarter. Inflation is not cooperating. And every time there's a new data release, the market reprices. That constant repricing creates exactly the kind of uncertainty that makes MBS investors nervous. And that nervousness gets passed to you as a higher mortgage rate. What this means practically is that the Fed cutting the federal funds rate by 25 basis points, or even 50, does not automatically translate into lower mortgage rates. The Fed controls short-term rates. The mortgage market is driven by long-term rate expectations, credit risk premiums, and liquidity conditions in the MBS market. These are different machines. And right now, those machines are decoupled in a way that has not happened since the aftermath of the 2008 crisis. The Fed can cut all it wants. If the MBS spread stays wide, your mortgage rate stays high. And here is the part that I think is genuinely underreported. The Fed knows this. They have the data. They have the economists. They understand the transmission mechanism, or rather the broken transmission mechanism, between their rate decisions and what you actually pay at the closing table. They know that their cuts are not reaching the housing market the way they historically have. And yet, the public communication stays focused almost entirely on the federal funds rate, as if that number is the one that matters for your mortgage. It is not. It has not been for 3 years. And as long as the conversation stays focused on the wrong number, millions of Americans will keep making financial decisions based on a signal that is disconnected from reality. I want to be clear about something before we get into the second half of this. I'm not saying this is some kind of deliberate conspiracy to lock people out of housing. What I am saying is that the incentive structure, the communication strategy, and the financial architecture all point in the same direction, toward a housing market that stays frozen, that keeps generating fee income for the institutions inside it, while ordinary people wait on the outside for a door that may not open on the timeline they have been led to expect. Whether that is malicious or just institutional dysfunction is almost beside the point. The effect on your balance sheet is the same either way. In part 2, we are going to talk about what this means for the two-tier society that is forming in real time around housing, what metrics you should actually be watching instead of the Fed's dot plot, and 2 specific strategies that exist right now to bypass the liquidity trap entirely if you are trying to buy, strategies that the mainstream real estate conversation almost never mentions. Stay with me. Now I want to talk about what this actually means for the country, not in an abstract macroeconomic sense, but in terms of the specific concrete divide that is forming right now between 2 groups of Americans. And then I want to give you something actionable, because this channel does not exist to make you feel helpless. It exists to make sure you're never caught off guard. Let's talk about the divide, because I think it is more stark than most people are willing to say out loud. There is a group of Americans who bought homes before 2022. Maybe they bought in 2019 or 2020 or 2021 during the pandemic surge. They locked in 30-year fixed mortgages at rates between 2.5 and 4%. On a $400,000 home, that is a monthly payment somewhere in the range of $1,500 to $1,900. That payment is fixed. It does not go up with inflation. It does not respond to Fed policy changes. It is locked in for 3 decades. And the equity those homeowners have been building, as home prices have stayed elevated even while rates have risen, means their net worth has expanded dramatically, even as their cost of living on housing has stayed stable. These people are sitting inside what might be the single greatest inflation hedge ever accidentally distributed to the American middle class. They are not going anywhere. They have a 2.8% mortgage, and they are staying in that house. Now there is the other group, the people who did not buy before 2022. Maybe they were too young. Maybe they were waiting to save a bigger down payment. Maybe they were told by parents or advisors to wait for the market to cool. Maybe they went through a divorce, a job loss, a health crisis that set back their timeline. Whatever the reason, they are now trying to enter a housing market where the median home price in most major metros is still $400,000 to $600,000, and the mortgage rate is hovering between 6.5 and 7.5%. On that same $400,000 home at 7%, the monthly payment is around $2,600. That is roughly $700 to $1,000 more per month than the person who bought in 2021 is paying on a comparable home. That gap, compounded over 30 years, is not just a number, it is a fundamentally different financial life. And here is what makes this particularly brutal. The people in Group 1 are not selling. Why would they? If you have a 2.8% mortgage and you sell, you lose that rate forever. You would be moving into a 7% mortgage on your next purchase. So they are staying put. Inventory is frozen. The homes are not coming to market. And the people in Group 2 are not just competing with each other for the few homes that do list, they are competing against an entire generation of locked-in homeowners who have no economic incentive to move. This is the two-tier housing economy. It is not a prediction. It is not a worst-case scenario. It is the current reality. And what it is producing at scale is exactly what we were starting to hear in the comments under our grocery cost video. People who are being squeezed on food, squeezed on energy, squeezed on healthcare, and now facing the prospect that the one traditional pathway to building long-term wealth in America, home ownership, may simply be closed to them for the foreseeable future. That is a profound shift. And a society where home ownership becomes a privilege of timing rather than a reward for financial discipline is a society with a very different political and economic future than the one we were promised. Now, some people watching this will say, okay, but rates will come down eventually. Give it 2-3 years. Eventually the spread normalizes, the Fed finishes QT, mortgage rates drift back toward 5 or 5.5, and the market reopens. And I want to address that view directly because it is not crazy. It is possible. But I want you to understand what that scenario actually requires and how many things have to go right simultaneously for it to play out. For the mortgage spread to normalize, you need the Fed to not only stop QT, but ideally restart some form of MBS purchasing, or at minimum, stop being a net seller into the market. You need credit risk in the broader economy to stabilize, which means no significant rise in defaults, no regional banking stress events, no major geopolitical shock that sends capital fleeing from long-duration assets. You need inflation to stay contained enough that long-term rate expectations remain anchored. And you need the political environment around housing, zoning, permitting, construction costs to improve enough that supply actually increases in the markets where demand is concentrated. All of those things happening together in the right sequence within a 2 to 3 year window while the global economy is navigating tariff escalation, currency stress, and a commercial real estate sector that is still working through serious distress. That is a lot to ask. I'm not saying it cannot happen. I am saying you should not be making a major financial decision based on the assumption that it will. So what should you actually be watching? Forget the dot plot. The Fed's own projections of where rates are going have been wrong so many times in the last 4 years that using them as a planning tool is genuinely dangerous. The number I want you to track is the MBS spread, specifically the difference between the current 30-year fixed mortgage rate and the 10-year Treasury yield. You can find this data on the Saints, Lewis Fed's FRED database. It is free, it is updated regularly, and it will tell you more about the actual direction of mortgage rates than anything Jerome Powell says at a press conference. When that spread starts to compress, when it moves back toward 1.7, 1.6, that is your real signal that the housing market is beginning to normalize. Until that happens, Fed cuts are noise. The second thing I want you to watch is the pace of quantitative tightening. The Fed has already slowed QT. They reduced the monthly runoff cap on MBS earlier this year, but they have not stopped it. Every month that the Fed continues to be a net seller of mortgage-backed securities is another month of structural upward pressure on the spread. If and when the Fed formally ends QT on the MBS side, or signals a pivot toward MBS purchases, that will be a genuine inflection point. That is worth watching very closely. Now let's talk about what you can actually do if you are trying to buy in this environment and you do not want to wait out a timeline that nobody can honestly predict. The first strategy is assumable mortgages. This is genuinely one of the most underused tools in the current housing market. And I think it is underused because most real estate agents either do not know about it or do not want to deal with the complexity. Here is how it works. Certain government-backed loans, specifically FHA loans and VA loans, are legally assumable. That means when a homeowner with one of those loans sells their home, the buyer can assume the existing loan, including the existing interest rate, rather than taking out a new mortgage at current market rates. If a seller has an FHA loan from 2020 at 3.1%, and you qualify to assume that loan, you step into their mortgage at 3.1% on whatever principal balance remains. The spread, the QT dynamics, the MBS market, none of that touches you. You're inside the old system, the one that still has cheap money in it. The catch is that assumable mortgages require the difference between the purchase price and the remaining loan balance to be covered with cash or a second loan, which can be complicated. They also take longer to close and require lender approval, but for buyers who have significant cash available and are willing to be patient and targeted in their search, this is a real pathway around the liquidity trap. There are platforms emerging specifically to help buyers find assumable mortgage listings, and I would encourage anyone serious about buying in the next 1 to 2 years to add this to their toolkit. The second strategy is seller financing, sometimes called owner financing, or a contract for deed. This is an arrangement where instead of borrowing from a bank, you borrow directly from the seller. The seller acts as the lender. You agree on a purchase price, a down payment, an interest rate, and repayment terms directly between the two parties, without a bank intermediary and without going through the MBS market at all. The rate you get is whatever you negotiate. For sellers who own their homes outright or who have very low remaining balances and are highly motivated, people going through estate sales, relocations, divorce, or who simply cannot find a buyer at current market rates, this can be an attractive deal on both sides. You get a rate that reflects a private negotiation rather than a distressed market. They get a sale they might not otherwise have. Seller financing is more complex than a traditional mortgage. It has real legal and financial risks that you need to understand before pursuing it, and it is far from a universal solution. But in a market where the institutional pipeline is broken, sometimes the answer is to route around the institution entirely. The broader point here is this. The housing market is not temporarily broken in a way that a couple of Fed cuts will fix. The structural shift that happened in 2022, the withdrawal of the Fed as the dominant buyer of mortgage-backed securities, created a new pricing regime for mortgages. That regime does not automatically reverse when the federal funds rate moves. It reverses when the underlying liquidity and risk conditions in the MBS market change. And those conditions are determined by forces that operate mostly out of sight of the average news cycle. The people who navigate this environment successfully will be the ones who understand the actual mechanics, the spread, the QT timeline, the MBS market, rather than the ones waiting for a headline that says the Fed cut rates again. Because that headline is going to keep coming. And if history is any guide, it is going to keep disappointing everyone who took it at face value. This is what recession warnings exists to do, not to predict doom, not to tell you to panic, but to make sure that when the system is operating in a way that is not in your favor, you know it clearly enough to make decisions with your eyes open. Track the spread. Understand QT. Look at assumable mortgages and seller financing if you are in the market. And do not let a number the Fed controls distract you from the number that actually controls your rate. If this video gave you something to think about, share it with someone who is sitting on the sidelines waiting for rates to drop. They need to see this more than anyone. And if you want to go deeper on the weekend protocol mechanics we referenced earlier, that video is linked below. Because what is happening in the banking system's plumbing is directly connected to why this trap exists in the first place. Stay prepared.